Okay, so good morning, everyone. Welcome to the Macro Snapshot. Recording this pretty early in the morning on Friday, February the 14th, 2025, St. Valentine's Day. May there be love in your life in whatever form it takes. Okay, talking of love, is there love for the markets? Okay, so let's have a look and see what's going on. Yesterday we had the PPI. So there had been some fears that after the hotter than expected, you remember on Wednesday we had the CPI, which was much hotter than expected. The main number came in at 0.5. And the market sort of went, oh my God, the Fed will, definitely not be cutting and maybe even has to hike. And inflation is not only sticky, but potentially going up. But what we have here, we had the PPI yesterday, which did come in a little bit on the warm side, but the market quickly recovered and took it as a relatively benign or even optimistic kind of sort of interpretation. Because as you can see here, these are the components for personal consumption expenditure, the PCE, which we know is the main metric which the Fed looks at for inflation trends. And what we can see here is that if you actually look at the PPI number, which came in yesterday, January 25, you can see that although the headline number was, a little, sticky, even a bit hot, a lot of these inputs, which are key for the PCE calculation, actually went down. So you can see here, airline passenger services down 30 basis points, portfolio management, doctor care, physician care, some hospital health care. So a lot of the healthcare things here, portfolio management, airline services, that actually went down. So the market took a few minutes to sort of figure that out. And that's why we actually had a little bit of the bonds sold off, but actually made a bit of a comeback. We had US dollar weakness, and we had the stock market, which was quite well supported. So it's sort of just interesting to sort of unravel some of the components. And from what I'm seeing on inflation, just doing a lot of reading and looking at different graphs and things, it seems to me that inflation is not a problem in the sense that it's high and accelerating. It's a sort of an annoying fact that it's not going down. So I think there's a bit of a nuance there. And the reason we have to look at this nuance is that obviously from the terms of the Fed, they would prefer inflation to be actively going downwards. So I suppose we have a Fed on hold for at least a few meetings, but that doesn't mean they're going to cut. And secondly, if the economy remains robust, if the employment market remains robust, in a certain sense, if we have sticky inflation around about, 2.3, 2.4, 2.5, 2.6, it seems as though the US economy in particular can deal with that. Of course, what would change that is if we actually get an inflationary jolt, if we get tariffs. And secondly, if inflation, for whatever reason, starts to go upwards, I don't know, maybe energy prices or something else. But at the moment, I think what the market is saying, like, a little bit annoying that this is not going down. We would prefer to have another Fed cut or two. But hey, we've already had 100 basis points of cuts. Debt servicing costs are actually quite low and the economy is strong. So let's just get on with our sort of business. That's sort of what's going on. Talking about tariffs, of course, we had another big announcement, or was it a big announcement yesterday afternoon from the Oval Office with Trump? And again, the market is reacting relatively positively to this because Trump had trumpeted, no pun intended, a big, sort of reciprocal tariffs sort of announcement, executive order, etc. But what we got, we didn't even get an executive order or any concrete actions. We basically have a situation now where Trump, it was like a memorandum of intent that, okay, the US will now be studying potential reciprocal tariffs on all countries. But it was kind of folded into this US Trade Department sort of survey or sort of analysis, which is due in April. So here we are again, February the 14th, middle of February. Essentially now we have 5 or 6 weeks until the sort of famous US Trade Department report, which will sort of analyze globally the effects of tariffs, who's putting tariffs on US imports, et cetera, et cetera. And then there'll be some kind of action, some maybe punitive action taken by the US administration. But if you actually look at the document yesterday, there was kind of a fact sheet released by the White House. What they're looking at, when I say they, I mean the White House and Trump, they're looking at a combination of and I've got a list here of import tariffs, VAT tax rates, so value-added tax rates, which countries charge on US imports, subsidies, regulatory burdens, and potential FX manipulation or foreign exchange misalignment. So if you start looking at all these things here, we understand that this is a very complex sort of set of ingredients. And essentially, I think probably what's happened in the White House is that Trump possibly was wanting to do like a 10% universal tariff, and sign a big document. But all of his advisors have basically said, Mr. President, this is very complex. We have to look at this whole shopping list of complexities and sort of figure it out. And so what Trump did yesterday, he didn't even sign an executive order, was simply to say, we're going to probably do something. But already we're seeing that India and Europe is saying, hey, we're going to buy more LNG, liquid natural gas, maybe some US oil. So just on as a side point, is this potentially a positive for the US energy sector? Because it seems that the easy fix for a lot of, like, let's say, for example, the Eurozone, let's say for India, even China, is just simply to say, hey, we need oil, we need LNG. US has plenty of that. Maybe we can just quickly redress the trade deficits by buying a little bit more of LNG. So it'd be interesting to look at companies like Cheniere in the US, or just the LNG complex, or even nat gas ETFs we can look at maybe in a second, and even maybe crude oil, just because they seem to be, at least over the medium term, a net beneficiary of an easy fix for a lot of sort of global players to essentially keep Trump happy by buying more US products, which of course can include energy. But the bottom line here is stepping back, is that I think there are two issues here. What is the two time frames? This is just my personal view. Is that potentially what we might be seeing is a bit of a sort of a risk on or a relief rally kind of situation for the next week or two, where the markets sort of go, oh, this is good. We didn't get any universal tariffs. Trump seems open to negotiation. He wants to make a deal. He just wants to sell a bit more oil and maybe LNG. He wants to claim a few public victories. And therefore, the stock markets are free to rally. Maybe the US dollar is going to have some weakness. And, that's the situation for the moment, a bit of a risk-on kind of situation, where risk-on currencies like the Aussie dollar, the Canadian dollar, the New Zealand dollar, the Korean won, these kind of trade commodity currencies do quite well. But if you step back and look at the bigger picture, it does seem that possibly, when we get this US trade report, which analyzes tariffs, and even more information about reciprocal tariffs, that maybe in April or May or June, so in the second quarter, second to third quarter of 2025, it does seem that there will be some increase in some shape or form on global tariffs, and tariffs, involving the US, which at the margin is going to be sort of slightly inflationary, at least in the short term. It's going to sort of gnarl up. It's going to make supply chains a bit more complicated. And in theory, this could be a drag, a bit of a negative for global growth. Maybe not by a lot, but certainly by something. And so at that point, do we see some kind of pullback in the equity market, and maybe a sort of a positive in bonds and a positive in the US dollar later in the year, like in the second quarter? So it's quite a complex mix of what's going on. The other thing which is complex is that the whole situation in Ukraine. Now, you know that we have this weekend, we have the so-called Munich Security Conference, where a lot of players are going to be there, a lot of US officials. Zelensky of Ukraine will be there. I'll just grab some tea. Earl Grey this morning. But the Russians are not going to be there. So Trump initially had said, yes, he spoke to his good friend Putin. Putin was going to be at the Munich conference, and that he and Putin would quite possibly be meeting in Saudi Arabia next week. But what we did hear sort of yesterday late afternoon was that actually Putin has said, no, we, the Russians and the Russian delegation, there will be no Russian delegation at Munich. Also, that Putin and Trump will not be meeting in Saudi Arabia. And thirdly, that Zelensky has been pushing back a little bit and saying, whoa, 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 whoa. There's not going to be some grand alliance or grand agreement between Russia and the United States, which doesn't involve Ukraine and Europe. And Europeans have also been pushing back and say, hey, don't expect that we're just going to, very casually give back any Ukrainian land to the Russians. So from a market perspective, what this means is that there had been some kind of idea of a sort of a peace dividend happening over the last 24 to 48 hours. And we've been seeing a rally in Euro stocks. We've been seeing a pretty strong rally in Euro. We've seen a little bit of weakness, in the Swiss franc. We've seen things like the Polish zloty doing very well. And globally, just a bit of a risk on kind of idea. This whole idea that, hey, Europe will have to rebuild, and peace is coming, and oil and nat gas would flow more freely. There won't be any more sanctions. So oil and nat gas will be cheaper, which is going to be a positive for Europe. So basically, this idea of a peace dividend and risk on. But as I say, in the last 24 hours, we've seen a little bit of complexity come into it. And my personal view is that any such agreement, probably, Trump and Putin would, and even Europe will force Zelensky to the negotiating table. But I think it's going to be long. I think it's going to be messy and more complex. And so what we're seeing is that some pullback in optimism in the last 24 hours. So what does that mean in terms of markets? It means that maybe, we can start looking at a couple of charts here. Let's say, for example, start off with the Euro USD, which is here. I think we've got this up here. So where's that? So yeah, so we could just look at a couple of sort of even in the European space. So you see here, there's been a strong move up in the Euro stocks. But again, just from my perspective here, you see I've got my sort of forward projection here that this might sort of top out at some point and come down. It's getting a little bit, I don't want to say parabolic, but this is very, very overextended on technicals. And you just have to wonder whether, I mean, it is a very bullish chart, but it's getting, as I say, is this getting ahead of itself a little bit? And this whole idea that, suddenly Europe's going to explode with growth and tariffs will not happen, and there's going to be a wonderful, quick resolution to the Ukraine-Russian war. Maybe, maybe not, but I'm interested to see over the next sort of week or so, just if this starts to top out. A similar kind of situation, we've seen the Euro, where is it? Euro USD. We've seen that it's had a nice little comeback here. But personally, I think that something around about the 105 level, there's going to be a pretty significant sort of a barrier up here, because this is the big trade range, this sort of pink lilac box here. So let's see if it pushes back into here. I think something like about 105. I'm looking at this level here, 105.30. I mean, could it go up to 106.25? Yes. But I think anywhere in this range here, it'd be interesting then to look at the geopolitics and the reality in Europe and say that, maybe this is an interesting short, because at the end of the day, the Fed is still on hold. The US economy is still on a relative basis outperforming the Eurozone as a whole. And we've had a nice run up in the Euro stocks. We've had a little bit of a bounce here in the Euro. So I'm thinking that could be an interesting candidate for a short at some point. But again, could it squeeze up more like to this level, which is 106.25? Yes, it could. So that could be the pain point, is that bit in the middle there. Of course, this is going to depend a little bit on the dollar. Same situation for the dollar. What I've been saying a little bit in some of these videos, I thought around here it should stabilize, because I thought it's going to be difficult to collapse. That's still my view, and I still believe that possibly in the second quarter of 2025, based on the fact that there will be some tariffs possibly coming in April, May, June, that there's still a bit more upside for the US dollar, or rather that I think there's a cap on the lower side. So, where could the dollar index get to? I think, let's say this 107 level, that's basically where we are now. That's a pretty good level there, which you see is a recent low. It's also a bit of support here. Could it go down to, down here, 106.40, 106.30? It could. But to be honest, I would be very, very surprised if it goes too much lower, because the fundamentals of monetary policy, interest rate differentials, domestic economic performance are still, in my view, supportive for the US dollar against other currencies. We know that the US dollar is losing its purchasing power against things like gold, but against other currencies, that's the situation. Okay, so if we go on to a couple of other things, just want to look here, and you see just this sort of risk-on sort of vibe. You see that, for example, the Aussie dollar having a nice little breakout against the US dollar. Again, risk-on kind of vibe. Let's have a look at the New Zealand dollar. Not as strong, but still doing quite well. We saw that USD CAD gave back quite a lot. And as you can see today, it's, whoops, let me just get rid of that. As you can see here, it's actually, continues to push a little bit lower. It has come a long way, about 9 or 10% over the last 3 or 4 months. So possibly just taking a little bit of a pause here. Interesting, just looking again in Europe, if we look at something like Euro versus CHF, which is the Swiss, you see here, it's interesting that Euro actually hasn't been able to maintain the strength against the Swiss franc. Now, we know the Swiss authorities, or the Swiss National Bank, they don't want a strong euro. They're worried about inflation, and they're worried about being uncompetitive from an export point of view because of a too strong Swiss franc. So it's interesting to me that the euro couldn't actually break out of this triple top here and push a bit higher. And is that some sort of indicator that actually there's still lingering a bit of geopolitical risk within the European space? This is Euro CHF. And maybe telling us that actually, the market is not completely convinced of an early and swift resolution to the Ukraine crisis, and that the European economy is maybe not that strong. So interesting one as a sort of a sentiment indicator to be looking at that. Because, for example, if you look at something like Aussie Swiss franc is done okay, but again, not that strong. So the Swiss franc remains a little bit bid, is the point I'm trying to make, and that could be a combination of Swiss franc fundamentals, but also just a bit of geopolitical risk. Talking about geopolitical risk, also just want to look at the energy space here, and what you guys can see if we look at the Dutch TTF contract, which is for nat gas, and this is kind of the benchmark for Europe. And we know that during the height of the Ukraine war, this thing exploded. But look at this here. It's come off significantly. I should have shorted this. It's come off significantly in the last 2 or 3 days, just based on this idea that, as again, that there will be a resolution to the Ukraine-Russia thing. There'll be more nat gas coming from Russia and Ukraine, which is going to, obviously be negative for the price. So let's keep an eye on that. But on the other hand, we've got oil, which is trying to have a little bit of a push up. There's a lot of technical barriers here for oil. And oil's sort of at an interesting point here because we had, we have different factors. We had this idea that there is going to be peace in the Ukraine and Russia, therefore less sanctions on Russia. That's a negative for oil. But then, of course, we've had a bit of pushback from Zelensky, as I just mentioned, and the Europeans saying, whoa, 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 not so fast. This is not going to be a quick resolution. So maybe actually these sanctions will remain. And secondly, we have the new U.S. Defense Secretary, what's his name, Pete Hegseth, who essentially is saying that sanctions remain on the table as a way of pressuring Russia to make a deal. So it's kind of a complex mix because Putin, on one hand, Trump is making overtures to Putin for peace, but on the other hand, the defense secretary is saying, well, no, we don't have a deal yet. We need to keep on pressuring Russia. So I think what's going to happen with oil, we saw a couple of the big sort of forecasting agencies saying that, the market is broadly balanced. I think here oil, realistically, it's going to be boring. We'll probably trade in a range, it looks like about $70, $70.50, maybe up to 75 in this $3 or $4 range here, just waiting to some kind of resolution. But just from a purely technical level, you see it had a pretty nice bounce off the lows here. Now, the question is, can this does it have the energy to, blow through, for example, if we look at sort of some, moving averages and whatnot. And you can see here that it's still a pretty weak price action here. This thing really has to, sort of push up another dollar or two to be in any shape or form bullish. But so at this point, it's just a reactive bounce. Might just sort of pop up a little bit more, but just a pretty balanced market. We can see that something like gold, if we just quickly flick across to the gold here. Gold, I wonder if this is a pause. I mean, there's good reasons to buy gold, but the thing is, with real rates at the moment, real rates are at about 2.25%, I think 2.5%, 2.25%. Gold doesn't yield anything. So we get a geopolitical risk, inflation risks, de-dollarization, central bank buying. We understand all the reasons to be buying gold. Debasement of fiat currencies, lots of big structural reasons as well. It continues to look very, very bullish, but just kind of interesting. I just wonder here if, we had a little bit of a shooting star here, rejection, but a little flattening out. Is this looking like a little bit of tiredness here? And again, this just could be technical. If we look at, some of the indicators I like to look at just from a technical perspective here. I mean, there's still a little bit more to run in terms of, let's say, a daily Bollinger Band, which is the red one, could still go up to the top of the Bollinger Band. And again, there's still like a big kind of upwards channel. So there's still upside here, but definitely very, very overbought. If you start looking at some of the like the stochastics and the indicators, I mean, we're sort of in the 80s and 90s, so very, very high levels of being overbought. So interesting, maybe not quite yet, but who knows if we get any kind of definite news advancement, let's say over this weekend at Munich, about peace initiatives in the Ukraine, maybe the geopolitical risk could come out of this a little bit, who knows. So gold's one which is looking maybe a little bit tired. On the other hand, you have oops, I've moved my fib, that's no good. You have copper here. So I just moved my fib, which is a bit annoying, but basically breaking out of the fib zone a little bit. But again, being pretty overextended here, a little bit of horizontal resistance. Is this a continuation or kind of a bit of a fake out at the top of the Bollinger Bands here? This particular indicator is indicating potential for reversal with this yellow candle here. We shall see, because again, for copper to remain bid and to really explode much higher, we're going to have to see some more positivity out of China. demand, global demand, global risk on. We know that the structural bid is there for data centers and electrification, but on a sort of a week by week trading basis, this has come quite a long way. Starting to look a little bit overextended. Let's keep an eye also on gold as well as copper here to look at that. Apart from that, guys, we have equities, which again, U.S. equities, global equity doing quite well, based on this idea that Trump's tariffs, are going to take at least a month or two or three or four to, potentially be imposed. If at all, there's going to be a place for compromises and whatnot. So we can see here that the ES, it decided yesterday just to sort of, push up against the highs, retest, but immediately rejected. So again, probably the most sensible thing is probably just to be trading within this range. Until and unless we get more clarity about tariffs and inflation. So this could push a little bit higher, but it feels to me as though the market is a little reluctant to really break out to, let's say, something like 6,300 or so. And again, we have a Friday, we have a headline risk over the weekend. So who knows today, maybe a fairly quiet day today. One final thing, guys, which I will mention is actually, I just wanted to show the oil curves just while I've got it on. Just sort of shows that oil is, not bad, but sort of trading sideways here. This is the CL1 to CL6 calendar spread. So the front contract versus showing us what demand is 6 months down the track. And what you can see here, this is just a 15-minute chart that had weakened, and now it's just sort of in a stabilization phase. So we're just going sideways in terms of the calendar spreads at the moment. And if you actually look at the curve, still in backwardation, but a little flatter than it was. So let's say if we look 1 month ago, you can see which is the yellow line here. Each dot represents a month. So you can see that a month ago, the outright price was much, much higher, but also look at the shape of the curve, much steeper in backwardation. So a much more bullish market here. And look how this is pretty flat. Although if we go compared to, let's say, yesterday, you can see, just again, I'll zoom out, which is this sort of turquoise color. You can see that the price has gone up and the shape of the curve, well, I don't know if that's going up, but still see the shape of the curve pretty flat. We really want to see the price going up, but also we want to see that front contract, those front 2 or 3 contracts really pushing up higher. And if we take off the 1 month, you can see just the differential here, that, it is pushing up higher at the front end here. This is the differential here, but we need to see more of that backwardation action to really get sort of any positivity, really. Just finally, guys, we've got the retail sales. Let's just see if there's any headline. I think there was a headline here from Zelensky a few minutes ago. Let's have a look. Anyway, we do have retail sales coming at 8:30. That's going to be important, as always, excluding autos and gas and the control group, which is kind of like the core number here, just to see the health of the US consumer. The survey is to be slightly weaker than last time. So it's going to be interesting to see if we have a lot of storms and everything in January for this number. So let's see if, the US consumer remains strong. If that's the case, potentially good news for equities, not so great for the front of the curve. Although I do think at this point that the front of the curve is pretty much stabilized. When the front of the curve, I mean like the 2-year and some of those SOFR contracts. The Fed's not really going to cut, but they're not going to hike. Pretty much trading in a range, probably 10 or 20 basis points here. Other information here, we get export price, just to see a bit of inflation news here, and industrial production is interesting. But that's, to be honest, second-tier data. I don't know if it's going to be massively market moving. Okay, I'll leave it there, guys. I've talked far too much. Have a great day. As I said, may there be lots of love in your life, and we will be talking again, no doubt, on Monday. Thank you.